Bitcoin bounced back, and at first glance that looks like good news. After dropping into the low 60K zone, Bitcoin is now trying to recover around the mid 60K area, and many traders immediately want to call it a comeback. But this is exactly where the market becomes dangerous, because a bounce is not the same thing as safety. A bounce only tells us that price found some buyers. It does not tell us whether the liquidity behind the move is strong enough to continue. And right now, the bigger picture is still not clean. Bitcoin is not moving in isolation. It is sitting between three major forces: ETF flows, the Federal Reserve, and capital rotation into AI and big tech. That is why this move needs to be treated carefully. If you only look at the candle, Bitcoin looks alive again. But if you look at the liquidity underneath the candle, the story is much more complicated. The first problem is ETF flow. Over the last several sessions, Bitcoin ETFs have seen heavy outflows. That matters because during this cycle, spot Bitcoin ETFs became one of the cleanest ways for institutional money to enter Bitcoin. When those flows are positive, Bitcoin has a stronger base. When those flows turn negative, the market can still bounce, but the bounce becomes weaker and easier to reject. In simple terms, ETF demand is like oxygen for this cycle. If that oxygen is fading, Bitcoin can still move up for a short period, but the move becomes more fragile. This is why the 64K to 65K zone is so important. It is not just a price level, it is a confidence test. If Bitcoin can reclaim this area with strong inflows, stable volume, and less macro pressure, then the bounce can start to look real. But if Bitcoin touches this zone while ETF flows remain weak, then this area can turn into a trap. Traders see the bounce, they chase the move, and then the market sells into them. The second problem is the Federal Reserve. The market wants rate cuts, but the Fed has not given investors a clean green light. Inflation pressure is still part of the conversation. Labor data has not fully broken, and bond yields remain a major pressure point for risk assets. This matters because Bitcoin trades like a liquidity-sensitive asset. When liquidity expectations improve, Bitcoin benefits. But when the Fed sounds cautious, or when the market starts to believe that rate cuts may be delayed, speculative assets become more vulnerable. That is the key point. Bitcoin does not only need crypto buyers. Bitcoin needs a macro environment where investors feel comfortable taking risk. If the market believes that money will stay tight for longer, then capital becomes more selective. Investors do not buy everything. They choose the strongest story, the deepest liquidity, and the clearest institutional narrative. And right now, that creates a third problem for Bitcoin. AI and mega-cap tech are still competing for capital. This does not mean Bitcoin is dead. It means Bitcoin is fighting for attention. When Nvidia, AI infrastructure, data centers, private tech companies, and future mega IPOs dominate the market narrative, a lot of risk capital flows toward that story first. Bitcoin can still be part of the risk asset universe, but it is not the only game in town. So when Bitcoin bounces while AI and tech are still absorbing market attention, we have to ask a serious question. Is new money really coming into Bitcoin, or is this just a technical rebound after a sharp drop? That question matters because many traps look strongest right before they fail. A market drops, then bounces hard enough to create hope. Traders start to believe the worst is over. Social media becomes bullish again, but underneath the surface, liquidity has not fully returned. ETF flows are still uncertain. The Fed is still cautious. bond yields are still uncomfortable, and capital is still rotating toward other themes. That is how a bounce becomes a bull trap. For Bitcoin bulls, the clean confirmation is not just price moving up for one day. The clean confirmation would be Bitcoin holding above the recovery zone, ETF flows stabilizing or turning positive again, and macro pressure easing at the same time. Without those pieces, the bounce remains suspicious. It can still go higher, but the risk of rejection remains high. For bears, the key level is the opposite. If Bitcoin fails to hold the mid-60K area and starts sliding back toward the low 60K zone, then the market will likely retest the same fear that appeared during the recent drop. And if that retest happens while ETF flows stay negative, then the pressure becomes much more serious. The danger is not simply that Bitcoin falls. The danger is that Bitcoin falls after traders already chased the bounce. This is why the calm metrics view is simple. Do not worship the candle. Follow the liquidity. Price is the headline, but liquidity is the engine. A green candle can attract attention, but if the engine is weak, the move may not survive. And right now, the engine still needs proof. Bitcoin needs proof from ETF demand. It needs proof from the Fed environment. It needs proof that capital is not simply rotating away into AI and mega-cap tech. So the real story is not Bitcoin bounced, everything is fine. The real story is Bitcoin bounced, but the market has not confirmed safety yet. That difference matters. A real recovery invites patience and confirmation. A trap punishes people who chase before the evidence is there. In the next few days, watch 3 signals. First, watch Bitcoin around the 64K to 65K zone. If it holds and builds, the bounce becomes stronger. If it rejects, the trap warning grows. Second, watch ETF flows. One green candle does not matter as much as whether institutional demand is returning. Third, watch the Fed and bond yields. If the market starts pricing tighter liquidity for longer, Bitcoin will have a harder time escaping pressure. The conclusion is not bearish for the sake of being bearish. It is risk management. Bitcoin may recover, but the recovery must prove itself. Until ETF flows stabilize and macro liquidity improves, this bounce still deserves suspicion. In this market, the first move is often emotion. The second move is where the truth appears. Bitcoin bounced, but until liquidity confirms it, this still looks like a trap.